Welcome back. This is Dr. Rao. We're continuing with the topic on investments. Now we're going to look at a completely different type of investment. Here we are buying life insurance policies. As we had discussed earlier, life insurance policy can be term life or whole life. When you have a whole life policy, there is some portion of the money that you get back even if you cancel the policy, and that portion is called the cash surrender value. So let's take a look at this exercise and see how it works out. Here we have Edible Chemicals Corporation that owns a $4 million whole life insurance policy on the life of its CEO, naming Edible Chemicals as the beneficiary. So if the CEO dies, the company will get $4 million. The annual premiums are $70,000 and are payable at the beginning of each year. So at the start of each year, they have to pay 70 grand for this insurance policy. The cash surrender value of the policy was $21,000 at the beginning of 2024. So again, I told you cash surrender value is an investment account, which means it's an asset. So here I have a T account and I have cash surrender value. They said it has a beginning balance of 21. Since it's an asset, it has a beginning balance of debit balance of 21. So the 21,000 obviously is a debit balance because it's an asset. They've asked us to do the journal entry for the first payment, for the payment we make on the first of the year in 2024. And then they have told us that prepare the appropriate journal entry to record the insurance expense and the increase in the investment, assuming the cash surrender value, the policy increased to $27,000. So we had 21,000. It grew to 27,000 the minute we paid the $70,000. So it has increased by $6,000. So this is a plug number. It was 21, it has grown to 27, which means it increased by 6. So how do I do this in the journal entry? Obviously, I now know cash surrender value has to be debited 6,000. I paid 70,000, which means I know I have to credit cash 70,000. So let's plug in those numbers first. Cash credit 70,000. My cash surrender value debit 6,000. So I have this balance of 64,000 and that is the expense. So when the company pays 70,000, not all 70,000 is an expense because I have 6,000 in cash surrender value, the asset that has grown. So the expense is only 64,000, which is a balancing figure. Then they tell us that at the end of the year, our CEO passed away, which obviously means I get that $4 million. I, being the company, gets the $4 million. So on December 31st, we say end of the year, let's just assume it was December 31st, and on that day we got the money. My journal entry is going to be cash debit. I'm getting the money, but remember 27,000 was my asset. Cash surrender value is an asset. I need to close that account now. So cash surrender value will be closed, 27,000. The cash I received is $4 million. So basically this cash surrender value was my investment. I got that 27,000. I told you I was going to get it. Whether I cancel the policy, well, effectively the policy is canceled now. So what happens to this remaining amount? 3,973,000. What do we call it? Well, kind of sounds a little bad, but it's called gain on life insurance settlement. So it's basically a gain on the policy. I was paying in money. I'd paid some money for over the years. The CEO has passed away. Cash surrender is 27. So this probably was not very long at all. And this is how much money I'm getting. And I call it a gain and it goes into the income statement. Again, cash surrender value is a long-term investment account. We obviously should not be hoping that our CEO passes away soon, calling it a short-term investment. It's a long-term investment account. Again, in this chapter, we have looked at investing in debt security, investing in equity security. Here is an investment in cash surrender value in a life insurance policy. So slightly different type of investment. So with that, we'll move on to the next exercise.